In 1661, a French finance minister named Nicolas Fouquet threw the most extravagant party Europe had ever witnessed. 17,000 guests, fireworks choreographed by artists who would later work on Versailles itself. A feast so opulent that the young King Louis XIV, barely 22 years old, sat in stunned silence as he realized his own minister lived better than he did. 3 weeks later, Fouquet was arrested by the king's musketeers. He spent the remaining 19 years of his life rotting in a fortress prison. Meanwhile, across the Atlantic, a century later, a man named Robert Morris, once the richest person in America, the financier who personally funded the Revolutionary War, died penniless in a boarding house, forgotten by the nation he'd helped create. These weren't stupid people. These weren't gamblers or fools. They were brilliant, connected, and powerful. They simply never understood what I'm about to tell you, that there are exactly 3 invisible thresholds in wealth building, and crossing each one changes the rules of the game entirely. Most people never even realize these thresholds exist, which is why most people stay stuck forever, wondering why the math never seems to work in their favor. My name is Tom, and I spend way too much time thinking about wealth psychology, compound mathematics, and what really changes when you cross certain financial boundaries. If you're someone who feels like no matter how much you save, you're not actually getting ahead, subscribe and like this video. It will help more than you think. By the end of this video, you'll understand the exact mathematical and psychological inflection points that separate people who build lasting generational wealth from people who spin their wheels their entire lives. I'm going to show you why the financial industry has zero incentive to tell you about these milestones, why your employer actively benefits from your ignorance, and how understanding these 3 numbers will fundamentally change the way you think about every single dollar you earn from this point forward. But first, let me take you back to Renaissance Italy, because what happened in Florence 600 years ago explains exactly why you're probably stuck right now and why the advice you've been given your whole life has been subtly, deliberately wrong. Let me tell you about the Medici Bank in 1434. Florence was a city of about 60,000 people, roughly the size of modern-day Flagstaff, Arizona, or maybe Bozeman, Montana. Not a major metropolis by any stretch. But this small city was generating more wealth than kingdoms 10 times its size. The Medici family didn't start rich. They were wool traders, solidly middle class by the standards of their time. Giovanni de' Medici had built a modest banking operation. Nothing special, nothing that would make you think his descendants would produce popes and queens and control the destiny of nations. But his son, Cosimo, noticed something that changed everything. And I want you to pay close attention here, because this insight is worth more than any investment tip you'll ever receive. Cosimo realized that there was a specific amount of capital, a threshold, beyond which money stopped behaving the way most people think it behaves. Below this threshold, money was defensive. You protected it, you hoarded it, you feared losing it. Every florin mattered. Every expense was a potential catastrophe. You thought in terms of survival, of making it through the next month, the next year. But Cosimo noticed that when you crossed a certain amount, something genuinely strange happened. You could start making mistakes without dying. You could take risks that would absolutely destroy a smaller fortune, but would merely dent a larger one. You could say no to bad opportunities because you didn't need them. Here's why this matters so much. Smaller bankers in Florence had to take whatever business walked through their doors. They couldn't afford to be selective. A bad loan? They had to make it anyway because they needed the interest payments. A risky venture? They had to participate because turning down business meant falling behind. They were trapped by their own vulnerability, but Cosimo could wait. He could let the desperate deals go to his competitors. He could wait for the perfect opportunity, the merchant whose ships were insured, the nobleman whose lands were unencumbered, the venture where the upside was enormous and the downside was limited. He calculated, roughly, that once you had enough capital to survive 3 consecutive years of complete business failure, you had crossed into a different category of wealth entirely. But here's the catch, and this is the part that changed how I think about everything. This advantage wasn't linear. It didn't scale smoothly. There was a specific point where everything changed. And below that point, you were playing a completely different game with completely different rules. It was like the difference between checkers and chess. Same board, completely different strategy. Cosimo identified 3 distinct thresholds, and he documented them in letters to his family that historians have been studying for centuries. The first threshold was what he called the breathing line. This was the point where you had enough that you could survive setbacks without panic. The second was the multiplication line, where your money could work so hard that it outpaced your ability to spend it on necessities. The third was the immortality line, where your wealth could survive your own death and continue growing for future generations. The Medici crossed all 3 thresholds. By 1513, they had produced 2 popes, multiple queens of France, and controlled more wealth than most European nations combined. They weren't just rich, they had transcended the normal relationship between humans and money. But here's the kicker, and this is what nobody talks about. The families who had started with similar amounts of money in 1434, who had been the Medici's equals and competitors, mostly disappeared within a generation or two. Not because they lost their fortunes in one catastrophic event, not because they were cheated or robbed or conquered. They faded away because they never understood these thresholds. They made decisions as if they were still at stage 1 when they had actually crossed into stage 2. Or they acted like they were at stage 3 when they were barely holding on to stage 2. They didn't update their mental models as their circumstances changed, and it destroyed them. So what does this have to do with you? Everything. Because these same 3 thresholds exist today, adjusted for modern economics, and they operate on exactly the same principles Cosimo identified 6 centuries ago. The numbers have changed, but the mathematics and psychology are identical. And just like in Renaissance Florence, almost nobody talks about them. Your financial advisor won't mention them because they don't fit neatly into a product pitch. Your bank doesn't care because these thresholds represent the point where you stop needing their products. The financial media actively obscures them because their business model depends on you staying confused, anxious, and clicking on articles about the next hot stock tip. But I'm gonna break them down for you with the actual numbers you need to know in today's economy. And once you see them, you will never think about money the same way again. Let me start with the first milestone. And I want to be extremely specific here because vague advice is worthless advice. Telling someone to save more money is like telling someone to be healthier. It's technically true and practically useless. So let me give you the actual number. The first net worth milestone that changes everything is $100,000 in investable assets. Not $100,000 in total assets. Not $100,000, including your car or your furniture or the equity in your house. $100,000 that is actually invested and growing in the market. Money that's working while you sleep. Here's what most people don't realize about this number. And it's something the financial industry will never tell you because it contradicts their entire marketing strategy. Below $100,000, compound interest is essentially a lie. I know that sounds harsh. I know every financial guru, every retirement calculator, every compound interest chart shows this beautiful exponential curve that makes it look like even small amounts will grow into fortunes. And mathematically, yes, compound interest works at any amount. The formula doesn't care whether you have $1,000 or 1 million. But psychologically and practically, it doesn't feel like it's working until you cross this threshold. And because it doesn't feel like it's working, most people quit before they get there. Let me show you the math, and I want you to actually sit with these numbers for a moment. If you have $10,000 invested and you're earning 8% annually, which is roughly the historical average of the stock market, you make $800 in a year. That's about $66 a month. It's nice, I guess, but it's not changing your life. It's not even covering your phone bill and streaming subscriptions. You look at your account at the end of the month, and it basically looks the same as it did at the beginning. The number moved, but you don't feel wealthier. You don't behave differently. And because you don't feel or behave differently, you don't make different decisions. The compound interest is technically working, but it's invisible. Now let's scale that up to $50,000. Same 8% return. That's $4,000 per year, about $330 per month. Better, definitely, but still not life-changing. A bad month in the market might erase 2 or 3 months of gains. It still feels fragile, uncertain. You're still nervous. But at $100,000, that same 8% is $8,000 per year. That's $666 per month appearing in your account. Now you can actually see it. Now it feels real. Now when you check your balance, something has actually happened. A bad month in the market might cost you $5,000, which hurts, but you know it'll recover. A good month might add 7 or 8,000. Your money starts to have its own personality, its own momentum. It's no longer just sitting there, it's doing something. This is where it gets really interesting. And this is the part that transforms how people relate to their financial lives. The psychological shift at $100,000 is actually more important than the mathematical one. When your investment gains start to become a meaningful fraction of your salary, your entire relationship with work changes. Think about what this means practically. Let's say you earn $70,000 a year at your job. When your investments are generating $8,000 annually, that's more than 11% of your salary being produced by your capital instead of your labor. You start to see your job as a choice rather than a necessity. Not that you can quit, not yet, but the handcuffs feel a little looser. The desperation fades just slightly. And that feeling, that subtle shift in your relationship with employment changes how you negotiate, how you take risks, how you think about opportunities. You might ask for that raise you've been putting off. You might finally leave that toxic team. You might take a chance on a new role that pays the same but has more growth potential. You're not as scared anymore. Now, you might be thinking, okay, that sounds compelling, but $100,000 is a lot of money. How is this actually achievable for someone who isn't already making 6 figures? And here's what I want to address, because this is where most people get stuck and give up. The journey to $100,000 is brutal. It's the hardest stretch of the entire wealth building process. And almost nobody tells you this. The financial industry doesn't tell you because they want you to feel like it's easy, like you're just a few smart investment picks away from wealth. Financial influencers don't tell you because brutal honesty doesn't get views. But I'm gonna be straight with you. Getting from $0 to $100,000 will likely take you 7 to 10 years of consistent saving and investing if you're starting from scratch with an average income. 7 to 10 years. It's slow. It's boring. It's the opposite of the overnight success stories you see on social media. Every month you're adding a few $100s, maybe 1,000 if you're aggressive, and the growth seems pathetic compared to your contributions. Let me make this concrete. Say you're investing $500 a month, which requires real sacrifice for most people. That's $6,000 per year from your labor. In your first year, with 8% returns, your investments might grow by maybe $200 or $300 on their own. Your contribution is doing almost all the work. It feels pointless. You're putting in $6,000 and getting back $6,300. Why bother? And this is exactly where 90% of people quit. They do the math, they see that the growth is almost negligible in the early years, and they decide it's not worth the sacrifice. They buy the nicer car instead. They take the vacation. They tell themselves they'll start seriously saving later, when they make more money, when it'll be easier. But here's the thing, and I need you to really internalize this. Getting from $100,000 to $200,000 takes roughly half as long as getting from 0 to $100,000. Not because you're suddenly saving twice as much, not because you got a huge raise, but because now your money is contributing meaningfully to its own growth. At 8% returns, your $100,000 is adding $8,000 per year automatically, passively, while you sleep. You're still contributing your $6,000 from savings. That's $14,000 per year of growth, nearly 2.5 times what you were achieving when you started. The snowball is finally rolling. And from $200,000 to $400,000, even faster. The acceleration becomes almost unfair at a certain point. This is what I mean when I say the first threshold changes everything. It's not just a number on a screen. It's a gateway to a completely different experience of building wealth. Before it, you're Sisyphus pushing a boulder uphill for eternity. After it, the boulder starts rolling on its own, and you're just keeping it pointed in the right direction. Let me give you a concrete analogy to make this visceral something you can actually picture. Imagine you're trying to fill a swimming pool with a garden hose. Not a fire hose, not a water truck, just a regular garden hose. For the first several hours, you're just creating a puddle. You come back after an hour of work and there's maybe half an inch of water spread across the bottom. It doesn't even look like a pool yet. It looks like a leak. Some of the water evaporates in the sun. You're standing there exhausted, wondering if this is ever going to work, wondering if you should just give up and go back inside. That's $0 to $100,000. That's the puddle phase. But once you have a few feet of water in the pool, something magical changes. Now when you add water, it rises visibly. You can mark the wall and see measurable progress every day. Your hose hasn't changed at all. You're adding the exact same amount of water, but the experience is completely different. The pool is helping you fill it now because the water has nowhere to spread. You stop thinking about quitting because you can see that it's working. The people who build serious wealth aren't necessarily the ones who save the most money or earn the highest salaries. They're the ones who survive the puddle phase. They keep the hose running when it looks hopeless. They show up month after month, year after year, contributing their $500 even when it feels meaningless. And once they cross that first threshold, everything accelerates. Now let's talk about the second milestone. And this is where things start to get genuinely counterintuitive, where the rules of the game shift in ways that most people never anticipate. The second net worth milestone that changes everything is $500,000 in investable assets. And this is the milestone that separates the merely comfortable from the truly financially secure. Here's why this specific number matters so much. At $500,000, using a conservative 4% withdrawal rate, which is the standard retirement planning assumption, you could generate $20,000 per year in passive income indefinitely. That's not enough to live luxuriously for most people, probably not even enough to live on at all in expensive cities. But it's enough to cover the absolute basics almost anywhere. Housing in affordable markets, food, utilities, transportation, the floor of human survival. But here's what most people completely miss about this milestone. It's not about the money you can withdraw. It's about the fear that disappears. When you have $500,000 invested, you are functionally immune to unemployment. I want you to really think about what that means. You could lose your job tomorrow, get fired, get laid off, have your entire industry collapse, and it would be a problem, yes, but it wouldn't be a catastrophe. You wouldn't lose your house, you wouldn't go hungry, you wouldn't have to take the first terrible job that comes along just to keep the lights on. You could take 6 months, even a year, to find exactly the right next opportunity. You could retrain for a new career. You could negotiate from a position of strength rather than desperation. This psychological shift is worth more than the $500,000 itself. You develop what I call walk-away power, the ability to say no to situations without facing catastrophic consequences. And walk-away power changes everything about how you experience work. Think about how many people stay in jobs they hate, working for bosses who mistreat them, in environments that are slowly crushing their souls. Why do they stay? Because they have to. Because they're 1 or 2 missed paychecks from disaster. Because they have no leverage, no alternatives, no cushion. Their employer knows this, by the way. That's why they can treat people so poorly. That's why they can demand unpaid overtime, deny promotions, offer insultingly small raises. They know you can't leave. But when you have $500,000 in the bank, you can leave. You might not want to, you might love your job, but you could. And somehow, paradoxically, knowing you could leave often makes your job better. You negotiate harder because you're not afraid. You set boundaries because you can afford the consequences. You speak up in meetings because getting fired isn't a death sentence. You become almost automatically more valuable as an employee because you behave like someone with options. And here's where the compounding gets almost unfair, where the mathematics start working overtime in your favor. At $500,000 earning 8%, your portfolio is generating $40,000 per year. Think about that number. That's probably more than you're contributing from your savings at this point. Your money is now your most productive employee. It shows up every day, works 24 hours without complaint, doesn't take vacations, doesn't call in sick, doesn't ask for raises or benefits, and produces $40,000 year after year. Meanwhile, because you're secure, because you're not desperate, you can direct your human capital, your time and energy and creativity toward opportunities that might not pay immediately, but could pay enormously later. You can take that interesting project that might lead to a promotion. You can start that side business without panicking about whether it'll work in the first 6 months. You can invest in relationships and skills rather than just chasing the next paycheck. Your money is handling survival while you focus on growth. Now you might be thinking, $500,000 sounds impossibly far away. When I talk to people about this milestone, I often see a kind of shutting down in their eyes, like they've decided this is fantasy, something that happens to other people. And I understand that reaction. I remember when I first understood these thresholds. I was at maybe $20,000 saved and feeling pretty proud of myself. The idea of $500,000 seemed like something that happened to trust fund kids and tech entrepreneurs, not regular people with regular jobs. But remember what I said about the acceleration effect. If you can get to $100,000, the path to $500,000 is dramatically shorter than the path from 0 to $100,000. You're not starting over each time. You're building on a foundation that's actively working on your behalf. Let me give you rough numbers. If getting from 0 to 100,000 takes 7 to 10 years, getting from 100,000 to 500,000 typically takes another 10 to 15 years if you maintain the same contribution rate. That sounds like a long time, and it is. But here's the thing, that time is going to pass regardless. 20 years from now, you'll either have $500,000 and true financial security, or you won't. The years will pass either way. The only question is whether you'll use them strategically. Let me tell you about what happens when people don't understand this milestone, when they technically reach it without psychologically internalizing what it means. In 2008, during the financial crisis, I watched countless people who had technically built up $500,000 or more in retirement accounts. They had done the saving, they had checked the boxes. Their account statements showed the right number, but they hadn't understood what they had. When the market dropped 40%, when their account showed 300,000 instead of 500,000, they panicked. They sold everything. They converted an unrealized temporary loss into a permanent locked-in disaster. They went from 500,000 to 300,000 and then watched from the sidelines as the market recovered without them. These people snatched defeat from the jaws of victory. Why? Because they had reached the second milestone without internalizing what it meant. They had the money, but not the mindset. They still thought of themselves as vulnerable, as people who couldn't afford to lose money, as people who needed to react to every market movement with fear. So when the temporary downturn appeared, when the paper losses showed up on their statements, they reacted like someone with nothing instead of someone with a fortress. The psychological shift at 500,000 is fundamentally about identity. You have to actually believe that you're secure for the security to work. You have to internalize at a deep level that market fluctuations are noise, that temporary losses aren't real losses until you sell, that your $500,000 will still be there, still growing, still protecting you, even after the worst bear markets in history. Otherwise, you'll sabotage yourself at the worst possible moment, exactly when staying the course matters most. This brings me to the third and final milestone. And this is the one that separates the wealthy from everyone else. The threshold that fundamentally changes your relationship with time itself. The third net worth milestone that changes everything is $2.5 million in investable assets. And at this level, something genuinely strange happens. Something that feels almost like cheating. At $2.5 million, earning a conservative 6%, not even the historical average of 8%, just a conservative 6%, you're generating $150,000 per year in passive income. For most people, in most places, that's significantly more than their working salary. Your money is now making more money than you can make with your time. You have crossed what I call the inversion point. Here's what changes at the inversion point, and this is where the game transforms completely. Below this threshold, your time is your most valuable asset. Trading time for money makes sense because your time, your labor, your effort produces more than your capital does. Every hour you work generates more wealth than every dollar you have invested. But above the inversion point, this equation flips entirely. Now your capital is more productive than your time. Every hour you spend working for money is actually an inefficient use of resources. The mathematics have inverted. This is why truly wealthy people behave so differently from everyone else. It's not that they're lazy or don't value work or don't want to contribute. It's that they've done the math, and the math is unambiguous. Working a 60-hour week to earn an extra $20,000 makes complete sense when you have $50,000 in the bank. That $20,000 represents massive value. But when you have $2.5 million, that same 60-hour week represents an opportunity cost of potentially far more in lost investment optimization, missed strategic decisions, or foregone business opportunities. Think about it this way. If your portfolio generates $150,000 per year, that's about $400 per day, every day, including weekends and holidays. If you spend 8 hours working at a job that pays you $300 for those hours, you've actually lost money in an economic sense. You would have been better off spending those 8 hours thinking about how to deploy your capital more effectively, or just doing nothing and letting the money work. The wealthy don't trade time for money because, for them, it's a bad trade. It would be like you accepting payment in a currency that's worth half of your local currency. Technically money, but objectively a losing proposition. But here's the catch. And this is where the conversation gets uncomfortable for a lot of people who are expecting some kind of get-rich-quick revelation. The path from $500,000 to $2.5 million almost never comes from salary alone. The math just doesn't work for most people, no matter how impressive their income sounds. Let's run the numbers honestly. If you're saving $50,000 a year, which is already an aggressive savings rate that most people can't achieve, and you're getting 8% returns, it takes roughly 20 years to get from $500,000 to $2.5 million. 20 years of maximum intensity saving. Most people who reach $2.5 million do so through some form of ownership. They own part of a business that succeeds. They own real estate that appreciates significantly. They own equity in a startup that exits. They own shares in something that grows faster than the public market's average. This is the uncomfortable truth about the third milestone. It's extremely difficult to reach through wages alone, no matter how well compensated you are. This is why the standard financial advice, save 15% of your income and retire at 65, is actually designed to get you to about the second milestone, not the third. It's designed to make you secure, not wealthy. And there's nothing wrong with security. It's an enormous achievement. But if you want to cross the inversion point, you need to think differently about how wealth is actually built. And this is where the antagonists of this story come into sharp focus. The financial industry, the media, your employer, the entire economic structure around you. They all have powerful reasons to keep you from understanding these thresholds. Think about who benefits when you don't know this information. Banks make money when you borrow. Every mortgage, every car loan, every credit card balance represents profit for them and delayed wealth building for you. Credit card companies make money when you carry a balance, when you pay 18 or 24% interest on purchases you made months ago. Financial advisors, at least the traditional kind, make money when you invest through them in expensive, actively managed funds instead of cheap index funds, skimming 1 or 2% per year that compounds against you over decades. And employers? Employers benefit enormously when you feel desperate, when you can't walk away, when you need this job, this paycheck, this health insurance so badly that you'll accept almost anything. They can demand unpaid overtime. They can deny promotions. They can offer 2% raises when inflation is 4%. They can treat you poorly because they know, and you know, that you have no alternatives. None of these entities want you to reach $100,000 in liquid investments. That's when you start to feel the handcuffs loosening. They certainly don't want you to reach 500,000. That's when you develop real walkaway power, when you become genuinely dangerous as an employee because you don't need them anymore. And 2.5 million? That's the enemy of every business model built on your financial insecurity. Here's how they keep you from getting there. First, they keep you focused on income instead of net worth. Every piece of financial media, every career article, every salary negotiation guide talks about how much you make, how to get raises, how to negotiate a higher starting offer. This isn't wrong. Exactly. Income matters, but it keeps you looking at the wrong scoreboard. Your income is what flows through you. Your net worth is what stays with you. Someone earning $150,000 and spending $140,000 has less wealth building power than someone earning $70,000 and spending $50,000. But we celebrate the first person and pity the second. Second, they push products and lifestyles that prevent you from reaching these thresholds. A new car every 3 or 4 years. A bigger house in a nicer neighborhood as soon as you can qualify for the mortgage. Premium subscriptions, upgraded phones, lifestyle creep that absorbs every raise before it can become savings. These patterns aren't accidents. They're carefully engineered by industries that profit from your consumption. They're designed to capture your increasing income before it can become increasing wealth. Third, and most insidiously, they make the first threshold feel impossible. Remember, getting to $100,000 is the hardest, longest, most discouraging part of the entire journey. If they can convince you it's not worth trying, if they can make you feel like the game is rigged and only people who are already rich or lucky can build wealth, then you'll stop playing. You'll tell yourself you'll start later, when you make more money, when the timing is better. And as soon as you stop playing, as soon as you give up on reaching that first threshold, you become a customer forever instead of a competitor. So what does this actually mean for you? And what can you do about it starting today? Let me give you specific, concrete action steps. Not vague advice about saving more or spending less, but actual things you can implement. First, you need to figure out exactly where you are relative to these 3 thresholds. Not roughly, not in the ballpark, exactly. Open every account you have, every brokerage account, every 401k, every IRA, every investment app on your phone. Add up everything that's invested in stocks, bonds, index funds, or other assets that can grow. Don't count your car, it's depreciating. Don't count your furniture. Don't count the equity in your primary residence. That's complicated and illiquid. We're talking about liquid, investable assets. Assets you could access without selling your home. What's the number? Write it down. Be honest with yourself. This is your starting point. If you're below $100,000, your mission is singular and urgent. Get to 100,000 as fast as humanly possible. Nothing else matters. Not optimizing your asset allocation between US and international stocks. Not finding the perfect low-cost fund. Not worrying about tax loss harvesting or backdoor Roth conversions or any of the advanced strategies you read about online. Just get to 100,000. This means cutting expenses ruthlessly. Look at your last 3 months of spending and identify everything that isn't essential. It means increasing income however you can, asking for raises, taking side work, selling things you don't need. It means automating your investments so the money moves before you can spend it. Pour everything into that first milestone. Survive the puddle phase. If you're between $100,000 and $500,000, your focus shifts. You've proven you can build wealth. Now you need to protect it while it grows. This means increasing your emergency fund to 6 months of expenses, real expenses, not the bare minimum. It means making sure you're not too concentrated in any single investment, not too much company stock, not too much in any one sector. It means beginning to think seriously about what walkaway power would mean for your career. Could you leave your job tomorrow if the environment became toxic? If not, what's the gap? And how do you close it? If you're between $500,000 and $2.5 million, your focus shifts again. This is where you need to start thinking seriously about ownership. How can you get equity in something that grows faster than public market returns? Maybe that means starting a side business and actually trying to scale it. Maybe it means negotiating for stock options or equity if you work at a growing company. Maybe it means investing in real estate, not your primary residence, but income-producing properties. Maybe it means angel investing or joining partnerships where you have meaningful upside. Whatever it is, the third milestone rarely comes from salary alone. The math doesn't work. So you need to start building the machinery, the ownership stakes, the equity positions that can actually get you there. And if you're above $2.5 million, congratulations. Genuinely, you've crossed the inversion point. But also, be careful. This is where people often make their biggest, most catastrophic mistakes. The temptation to take enormous risks increases dramatically when you feel wealthy. People start chasing exotic investments, making concentrated bets, trying to turn their $2.5 million into $10 million quickly. And ironically, this is often exactly how people fall back below the threshold, sometimes all the way back to the beginning. The goal at this stage is to protect the position that took you decades to build while finding intelligent, measured ways to deploy capital. This is not the time to get clever or to chase returns. This is the time to be strategic, to diversify properly, to think about legacy and sustainability rather than rapid growth. Here's the final thing I want to leave you with, and it's the real lesson from the Medici that most people miss when they hear their story. The families that didn't make it, the ones who had equal amounts of money in 1434 and disappeared within a generation or two, they didn't fail because of bad luck or external circumstances. They failed because they didn't update their mental models as they crossed thresholds. They made stage 1 decisions when they had stage 2 money. They acted like they were still vulnerable when they had actually built real security. Or they made stage 3 decisions, bold bets, concentrated risks, when they were barely holding on to stage 2. They didn't understand that different levels of wealth require different strategies, different mindsets, different ways of thinking about risk and opportunity. Remember Nicolas Fouquet from the beginning? The man who threw a party so lavish it got him thrown in prison? In 1661, Fouquet had accumulated more personal wealth than most nobles in France. He had built the most beautiful estate in the country. He had the art, the connections, the power. By every financial measure, he had crossed into the highest levels of wealth. But he never understood the rules at that level. He behaved like someone who could flaunt his success without consequences. He threw a party so extravagant that it made King Louis XIV feel inadequate, feel threatened, feel that his own minister was more powerful than the king himself. Fouquet had crossed into a new level of wealth without understanding a crucial rule at that level. You never threaten people who have different kinds of power than you. His money couldn't protect him from political power. He died in prison because he confused financial capital with total security. Robert Morris, who financed the American Revolution, made the opposite mistake. He had crossed the inversion point fairly. His investments were generating more than he could earn through labor, and he got overconfident. He speculated wildly on frontier land, leveraging his existing fortune to buy vast tracts of wilderness that he expected to appreciate. When the land bubble burst, when his speculations failed to pay off, he went from one of the richest men in America to debtor's prison. He died in a boarding house, forgotten by the nation he had helped create. The lesson from both stories isn't to avoid wealth. The lesson is to understand what kind of wealth you have and what rules apply at that level. The game changes as you cross each threshold. The strategies that got you to 100,000 won't get you to 500,000. The mindset that served you at 500,000 will hold you back at 2.5 million. And if you don't evolve, if you don't adapt your approach as you cross each threshold, you'll either stagnate below your potential or sabotage what you've built. The 3 net worth milestones, 100,000, 500,000, and 2.5 million, aren't just numbers to achieve and check off a list. They're phase transitions. They're points where the physics of money fundamentally shifts, where the rules that governed your previous stage no longer apply. And now that you know they exist, now that you can see the game board clearly, you can plan for them, you can push through the brutal slog to the first one. You can build the security and walkaway power that comes with the second one. And you can position yourself through ownership and equity to reach the third one, even if the path isn't obvious yet. The Medici figured this out 600 years ago with nothing but observation, mathematics, and the willingness to think differently about money than everyone around them. They didn't have compound interest calculators. They didn't have index funds. They didn't have tax-advantaged retirement accounts. They had insight, patience, and a framework for understanding wealth that most people never develop. You now have information that most people will live their entire lives without ever encountering. The financial industry won't tell you because it doesn't profit them. The media won't tell you because complexity doesn't generate clicks. Your employer won't tell you because your desperation benefits them. But now you know, the question is what you're going to do with it. If this video changed how you think about money, hit subscribe and leave a comment telling me which milestone you're working toward right now. I read every comment, and I'm genuinely curious where you are in this journey. I'll see you in the next one.